does not share his mobile number with you.
And Nathaniel, making it probably a little bit more personal, you're obviously running a business yourself. What were the steps that you took in your journey?
I think it's in all of us, like we want to make a difference. Like it's something that I've always like had inside of me. After working for a few different companies, I wanted to step out and start my own business. With entrepreneurship or with a business, you can build something that is...
That's actually one of the most interesting things I've heard.
What are some of the things that you can do to product and equipment perspective to actually set yourself up?
I feel like this is something that's most close to you two gentlemen, because the reality is that...
Now, is debt a bad thing?
So if you're going to start a business, you should have some savings there. Because for the first year or two, most of the time the cash flow, you still got to build it up, you got to market, you got to find your clients. Like you got to have some savings there, unless like you're going to get a gift from your parents or something like that.
Just because you're a qualified doctor, you're a neurosurgeon, doesn't mean that every single person in this neighborhood even knows you exist. I've been dying to say this. The famous accounting tax answer will always be...
So today we're going to be talking about all things property, accounting, self-managed super funds. What are the other things that you're particularly interested in?
Finance, how to start a business, how to get into a property, especially as a medical professional.
Yeah. Zander?
The year is 2024. Where do you start?
It's pretty cool. And then what are some of the traps that people make when it comes to buying a property? Do they buy something fit for purpose or not? How do you pay for a fit out? Where do you get the money from? It's just one of those things that's going to be a well-rounded conversation. Lots of rabbit holes. So if you stick with us through to the end, hopefully you'll pick up some pearls of wisdom.
Yep. And don't forget to leave your comments below.
One of the things that, so a lot of the product that I've got is leasing. Mm-hmm. But the thing is that there's a place and a time for that. And it might be where you want to go capital light. But you use the same structures that might set you up in the future to get the tax effectiveness. Is it only in a market where you buy?
It's interesting that you brought up capital light, because that then actually brings you straight back down to the economic decision. You've got scarce resources. Money is a scarce resource. If it wasn't, then you wouldn't be worrying about making more money. Mm. So your structure, like you said, is the starting point. And then the strategies that you have to employ in order to get what you need done. In other words, do I rent or do I buy or do I invest? Do I do an SMSF? And going capital light might be the very first starting point, is to make that formal decision and say, based on where I am in my career, in my life, with my family, with my income, with my bank balance, how do I maximize my company's capabilities and potential for the future, knowing that I could do for the first 2 years rent. I might do a shared space. I might save money by going capital light for 3 years and then building up finance capabilities, talk to Loan Lounge, or getting to the point where after 5 years I know, what's the point of renting? I'm losing so much in after-tax income. I'm losing so much in equity that's being lost. These are the kind of things that they need to think about.
Zander, from your perspective, what is the difference between a service and a product?
The reality comes down to some jobs take time and you get paid for the time that you're doing. And some businesses create products that could be sold and scaled. And it depends what the product is and it depends what the job is. But ultimately, if we're talking about legal, medical, or engineering, or chartered accounting, or brokerage, or real estate, a lot of the time you're spending 40 hours to do something for someone else's benefit, where they're not holding something tangible, but you're doing a service. You're doing something that takes your time and gives them a result that they're paying for. So a doctor isn't selling you a cupcake. They're not selling you pizza. They're not selling you calculators or pens. They're saving your life. They're sewing up your sutures and scars, and they're cutting out your appendix and all these magical things. But on the other hand, you've got companies that are making donuts, or companies that are making pizzas, or companies that are making Macintoshes, whatever the object might be. The difference is that a lot of those companies that are selling products, hard, tangible items, they've got a completely different economic slice when it comes down to revenue, cost of goods, requirements for land, buildings, manufacturing. Whereas I'm a chartered accountant tax agent. I have no real costs other than my time. So that means that I'm all service industry based with revenue and almost no costs, which makes it very difficult for me to manage taxes because there's too much money coming in versus money going out. And doctors, lawyers, engineers, exactly the same problem.
And so from your experience in dealing with doctors in the past, and Nathaniel, I'll come across to you in a second, but what are the pain points that you're commonly seeing around doctors and their day-to-day life? What does their life journey look like?
I think Nathaniel knows this as well. Time poor. There's a lot of passion and there's a lot of purpose that I see the difference in with doctors. Doctors start off on a 15, 20-year journey to get qualified and to get to the correct point where they can become absolutely experts in their fields or whatever they're doing. You were talking earlier about ophthalmologists, things like that. It's not a 3-year course. That's 7 to 10 years of medical school, advanced internships. They got to work. They got to do advanced specializations on top of that. It keeps going. And during that timeline, they don't get to start working when they're 21. They only maybe suddenly start working and actually getting a payslip and superannuation when they're like 29, 30. They've lost years compared to the rest of us schmucks that just, happen to fall out of university and get into a job. The doctors have invested, and they're eventually going to get to a point where it's going to be repaid. But while they're waiting to get there, time is marching on.
And do you think that that puts doctors on the back foot from a superannuation's contribution perspective?
1,000%. I'm sorry to use percentages, but yes.
And what does that mean?
You were talking about capital lights and all of these things. There are so many decisions to be made in your life. And take away being a doctor, take away being a lawyer, take away being an engineer. If you're a person and you're living in a society, you got to live somewhere. You got to rent. You got to pay for food. You got to transport. You got family. You got a whole bunch of different considerations. And as a doctor, if you're withholding 14 years worth of full-time earnings, you got to catch up very quickly. And most doctors eventually get an SMSF, a self-managed super fund, for those who don't know. Most doctors, they'll have to start doing concessional contributions to their super to catch up as quickly as they can. Everyone here knows about the power of compound interest.
Yep.
The longer timeline, the more you make. And the doctors potentially have a handbrake on their timeline compared to other people, maybe 13 or 14 years. And no one goes into a doctor or being a medicine or working as physio or doing anything in the industry just to make money. They do it because they're passionate about what they're doing. So they're prepared to wait those 14, 15, 20 years to get to that point. But at a certain timeline, they have to reach a stable position where they can have a house, an investment property, a self-managed super fund. You were talking earlier about capital light versus capital heavy. You got to sometimes have your own practice. You got to have your own building. You got to build that kind of base.
And we're also talking about products versus services. So how do you productify being a doctor when it is a heavily service-based industry and you are effectively trading time for money? Is that something that, I know a surgeon, for example, might accidentally have an injury to their hand and then they can no longer operate. What does that mean? How do you actually help productify your business as a doctor?
It's absolutely one of the best questions in the world, and this is why big insurance companies exist as well. But the reality comes down to, if you're a doctor and you've got 40 hours a week, maybe you're working 60, maybe you're doing 80. It depends on how willing they are. But you've only got X amount of time. You've got a constraint. You've got a ceiling. You can only do 40 hours, let's call it that. The only way to productify what you're doing is to have a team, is to have other people working in your practice, is to have people who are using your methodology, your technique, your learnings and understandings, and doing it at the same high level of quality and, how do I say this the best way, repeated success. But that's one thing. It depends on what the type of doctor is. Another thing could be, if we are doing a certain type of procedure, have we thought of a smarter way to do it? Have we developed different tools to do it? Have we got new ways to scale it in order to bring it around? I used to work for a big cancer research company in America years and years ago, and they, by mistake, worked out a way to solve meniscus problems using a little tool that looked like one of those extender scissor things that you can reach high-level stuff from. And they would create this little thing and go into athletes' knees and then fix the meniscus by pulling something around and doing sutures and all these magical, fancy medical things. And they just started making that instead of the cancer medication. So they could have cured cancer years ago, but they decided to make these little small snippy tools. Short-term sight. But to answer the quick question, it just comes down to, you can scale up, but you'll probably need a practice, which then leads us back to the whole conversation about real estate and about economics.
Yeah, I think like what you're sharing, like based on the doctor and how much they study and what they learn, they're learning basically how to become a doctor, right? But then if they're going to like do that as scaling or like building something else. They actually need to learn like business skills almost to build a business. Like you're an accountant, you learn to be an accountant at uni, but they don't teach you how to actually run a business, right? Same as me. They teach me how to become a broker. I'm good with finances, but I don't actually know how to run a business. I need to learn. So in terms of building a practice and all those other things, like how does a doctor even like change their mindset to think about that?
It's called the School of Hard Knocks.
Yeah.
And on the School of Hard Knocks, what does that mean? Does that mean that there's potential to get exploited by people that maybe don't have your best interests at heart?
It's possible, but I mean, most of the time you get the ATO knocking your door, reminding you about something you forgot to do. I think most of the time when a person's ready to stop working for someone else, as a doctor, they'll start their own practice. As a lawyer, they'll register with New South Wales or Queensland or with Victoria Law Society. If you're an engineer, you already have half of the mathematics behind your name. All you're doing now is you're working out what's the commerce. So yeah, lots of things to do, but I think always the first step is just taking that leap of faith. And a lot of doctors, they know they're good. They know they've got steady hands, there's no shake, there's no accounting nervousness that we have on our side. You know, we stare at our shoes, we can't look at people in the eyes. But doctors have a confidence that kind of confidence is what gets you the big house on the hill.
Yeah.
And you have to learn by making mistakes in business in order to go forward.
Yeah, when you say that big house on the hill, I'm thinking about a doctor. You know, they've got another mortgage. There's a big house on the hill. They're getting this good income from their employer, whoever it is. And so for them to step out and start the business, you know, they're probably like restrained already in terms of taking that risk. But that's probably a similar question to a lot of people out there who are working for someone and they want to take that step or that leap of faith as well.
And Nathaniel, making it probably a little bit more personal, you're obviously running a business yourself.
Yeah.
What were the steps that you took in your journey that actually might apply to somebody that's actually considering running their own business and taking the plunge from being in a group practice or something like that?
Yeah, that's a good question. I think for me personally, growing up, I think it's in all of us. Like we want to make a difference. Like it's something that I've always like had inside of me. And so I kind of followed the system, did what my parents told me to do, come out, start uni, finish uni, and then go out and get a job, and then, you know, like buy a property, and then get into a relationship. And then I think that's just something that I didn't want to do. Like I felt like there was something more inside of me. So I think after working for a few different companies, I wanted to step out and start my own business. And I think like our business is quite unique because our tagline is financing a difference. So we give 10% of our trial income to end human trafficking. So basically I wanted to build a business to help people and make a difference. So with entrepreneurship or with a business, you can build something that is pretty much, I would say the business is always a reflection of you, right? How good the business is will be based on how good you are. So if I want the business to grow, then I need to grow. So I think there was a kind of mindset shift. And I think there's a shift in terms of continuously developing and growing as well to help make the business work.
That's actually one of the most interesting things I've heard, how good you are and how good the business are work in unison.
And so looping back to the whole idea around productifying your business, obviously the bottleneck around I just don't have enough time, maybe bringing in extra staff to deliver services that aren't up to the same, I guess, skill set or training requirements is what, as a doctor, you might have delivered. So let's just say that in some instances there might be things that you can pass on to somebody that's in your team that maybe team members that are more readily available, and then whilst you focus on your hyper specialized area of interest, what are some of the things that you can do to, say for instance on the product and equipment perspective, to actually set yourself up so that you've got a practice? Because that's obviously one of the things that I constantly hear is, how am I going to pay for all this sort of stuff? If I'm taking that leap and I'm starting my business, how do I afford this?
I feel like this is something that's most close to you two gentlemen, because the reality is that you're the least negotiator. You're the guy that helps them set up these big practices. A lot of the times your incentives as a starting doctor, especially if you need like an MRI machine or a special dentist chair or some $400,000 magic equipment that's going to help you do the little knee cut thingy, that stuff all gets part of the rental agreement. It's part of the incentives. It can be negotiated, and it's also part of the equipment finance that you get from the banks. It's part of the maybe a partnership buy-in. You guys are participating by getting the right kind of finance in order to get these things. On top of that, you got all of the incentives that you get from the ATO. Back in 2023, it was the best time ever, 150K instant asset write-off. Then afterwards, they started doing the accelerated ones. But I mean, this is especially, I mean, I would say the first two goals of the doctor or the medical practice is to say, number one, how do we negotiate the best with our landlord for the fit out? And number two, when they're dealing with the brokerage and the mortgage, how do we get the best possible finance through every channel that's available? Because the doctor's not going to go away. People need the services. We're all unhealthy eventually.
Yeah.
We do have an aging population demographic that's looming.
And you're talking about my grey hairs?
Yeah, well, I've got them too. I've just noticed today. And then the other thing is that the replacement rate in terms of people are delaying putting off having families, and so what does that mean for our population? And so are we going to have to get more efficient in health and how it's delivered and all of those sorts of things? And to go back into the rabbit hole, I guess, of I've got this ambition of stepping out on my own, but I don't know where to start. What are some of the things that you can do from a money perspective to access the money that you require or structure things? And obviously, I can talk about things like landlord incentives and then they'll dovetail in with a mortgage broker offering, and maybe from a SMSF or self-managed super fund perspective, there's a whole bunch of different ways that things can be looked at. But how do you actually get your hands on the money as a doctor so that you can control your own destiny? Nathaniel, this is probably for you.
Money man.
Yeah.
I guess when it comes to lending, I always think of it in like simple five C's. I call it the 5 C's of credit. So for example, first C is character. Like what's your character like, and do you have a willingness to repay the loan? And sometimes you can just check that through like account conduct, savings, etc. The other C is capital. How much capital are you putting into this transaction, right, or into this deal? The third one is your capacity to repay. Basically, how are you going to repay this loan when you take it out? The fourth one is like collateral, or the security that we're taking, that asset or that equipment. Is it easily sold? How long is it going to last? Etc. And then the other fifth C is like just conditions, basically conditions of the market. Does the bank have an appetite for lending? What are the interest rates like? What's the economy like? So all those kind of come into play in terms of lending money. But I think when it comes to a doctor, the great thing about being a doctor or a medical specialist is that the bank actually has like these special divisions where they're called like medical divisions or medico divisions, and they actually treat doctors or medical professionals as a higher standard, or they give them like better service or better policies, because they know that like the capacity or the income is going to be there all the time, right? They even lend you very unfair. Yeah, very very unfair. They sometimes even lend you up to 90-95% on a property, but for the average person, if you're going to lend that amount, then you're going to pay something called mortgage insurance. Like simple things like that for a medical professional. They get a lot of benefits that a lot of people don't know about. So I think there's some benefits there already.
And so when it comes to getting your hands on some money that's been loaned to you, obviously, if you've got a bucket of cash that you've saved up, that's what you would say is what your equity. Yeah. And then you would have potential debt. Now, is debt a bad thing? Zander, this is for you, actually.
But I think before you get to that, like savings, right? If you're going to start a business, you should have some savings there. Because, for the first year or two, most of the time the cash flow, you still got to build it up. You got to market, you got to find your clients. Like you got to have some savings there, unless like you're going to get a gift from your parents or something like that.
But just because you're a qualified doctor, a neurosurgeon, doesn't mean that every single person in this neighborhood even knows you exist. Yeah, that's right. They won't go to you first because they don't know that you're there. It doesn't matter how much capital you've outlaid and all of these things. The business still has the normal rules of life. Yeah. There's natural law. Yeah. The oak tree doesn't just pop out of the ground. It takes 20 years to get to that size. Yeah. So 100%. And to go back to the question about debt, the famous accounting tax answer will always be, it depends. And the very quick answer, if you've got yourself a beautiful commercial building and it's $3 million and you've built it in Glebe or 5-Dock and you can see that it's going to raise in value over the next 5 or 6 years, then cool. The mortgage is great. You're paying off a mortgage on an asset that is rising in value. But if you're buying yourself the brand new Ford Raptor that's $97,000 and is going to be replaced next year's model in 6 or 7 months' time, and next year is going to be 60 grand off the ground. That's not good debt. That's not smart.
I really like the Ford Raptor. Don't bag it.
I'm bagging the Ford Raptor.
Unless
I'm a
the
Triton
Raptor's
man.
gonna bring in some income.
It's a very cool truck. But yes, I totally understand. So what you're saying is that debt, when deployed on something that's an appreciating asset, can be a really smart way of multiplying your exposure in a positive way. And because risk and return go hand in hand in business, right?
This is your bread and butter. You're literally sitting on the gold mine of the appreciating assets. Now, the problem is it's not black and white. It'll never be simple and easy. The rules of debt can change like the wind. Back in the GFC times, people were loving the collateralized debt securities. Now we're in a point of view where people are now looking at things like NFTs and blockchain and stuff like that. The reality comes down to that it's going to be a product of its time. You're going to get different bond yields. You can have different inflation rates. You can have a whole bunch of different factors. Right now, and probably for the last 150 years, property is a very good idea. And I don't think property is going to be a big problem in the future if you've already started doing your savings and your finance and your investigations. Stick to property.
And so would the statement, debt amplifies your gains or amplifies your losses? Is that a true thing?
It depends on the nature of the item. Again, the nature, because you get derivatives, you get calls and puts and options and types of different financial instruments. But a property, if you think about it, ends up in Australia specifically having major two components, which is the fixed portion, and then you get a variable portion. And the variable portion is something that you negotiate with the bank, same with the fixed, but the variable is more dependent on something like the Reserve Bank CPI or the prime lending rate. The bank always adds a percentage. The percentage that they add is going to be a little premium that they charge to cover the admin costs and the markup that they need to require. So if you think about it, you've got a fixed portion, which is the strong debt that you know about. You've got a variable portion, which right now everyone's feeling the crunch. We all know that everyone's talking about it. But at the same time, if you're dealing with this asset as though it was a taxable business, your interest is now deductible. And the high interest rates means higher deductions. And if you were smart, you went to a tax agent and you got yourself a whole bunch of lists of concessions and deductibles that you know that are part of the management of this asset. And you've received a depreciation report that helps you claim back the useful life of the asset from the tenants that you're renting it out to. And eventually you get into a position where the asset is doing its own work for you. And you hold it until the such time that you're ready. Maybe over the course of 20 years, it's tripled in value. And all of a sudden, the debt that you were worried about 20 years ago has been the greatest thing in the world for you. You've made a fortune out of it.
So is that also a way of productifying your business in a service industry through smart investment into property?
These questions are amazing. The reason I say this is because what you see on the surface when you're dealing with like an iceberg, 90% is what's underneath it. You may have, for example, built a business that's more valuable for the property that you're holding compared to the practice that's occupying it. Great example is McDonald's. Everyone thinks McDonald's sells hamburgers. No, they own the most expensive corners in the world. People think Avis rents out cars. No, they sell short-term insurance. Every 2 or 3 days, they're selling new contracts that cancel out in 3 or 4 days' time. Like the real business of a doctor might be, you become a property magnate. Your practices are paying for the cost of that mortgage over the next 25 years. That's generating your cash flow. But the reality is that you've built yourself a property portfolio with $30 million. All because, and this is probably where we come back to the start, you've productified your practice and what you do, your policies and procedures, so that you can open up more practices that follow your methodology. Bryce, you've solved it.
I don't know if I did. I think I just asked a bunch of questions.
If I was a dentist, that's what I would do.
Going back to right at the very beginning, we were talking about, you've trained. You've become the equivalent of a rocket scientist, but in your medical field. And you've got out, and obviously it's time to make the plunge. So what would the next practical stages be? And Zander, I think that probably maybe give you a top 5 steps for just getting ready. And then Nathaniel, what we can do is we can actually talk about the steps for applying for a mortgage or a loan or something like that, whether it be equipment finance or the other forms of debt that you might think would be relevant, you can actually know where to start. Because the thing is that somebody is stepping out and they're going, I don't know who to talk to, what to do, how much it's going to cost, how much do I really need to save, like all of these things. And these are questions that I get asked every day, going about the process of working in property. And so Zander, over to you.
If you've just qualified and you've gotten ready and you know what you're doing, you built up your nest egg, it's a very good point to ask yourself, now what? Where do I actually begin? I've been dying to say this. You cannot use Dr. Google. Dr. Google doesn't know what's going on. And we've checked on ChatGPT. It can't solve a lot of the tax questions. They're very good and they give you the impression that they know what they're doing. But the reality is that just like a real doctor, you're going to have to go to someone that's qualified. I think first step, 100% talk to a tax agent or a financial planner or something like that, just to get the overalls, because you need to work out the economics. Once you've done that, it's quite easy. You have to define your structure, because in order to make money in Australia, you must have an ABN, an Australian business number. But the Australian business number could be held by you as a sole trader in your own name, or it could be held by a company, or it could be held by a trading trust or an investment trust or a different form of structure. You could be a partner in a partnership or a joint venturer, but you need to work out exactly what structure to do. And if you do not speak to someone qualified in tax or financial planning, you're going to find out 20 years later that your choice of structure could impact you in very profound ways. One of the first key things to do is define your structure. Number two, you need to work out who are your customers. Because the only reason that you're starting this business is for your clients, your patients, the people who you're generating revenue from. Your exchange is you're saving lives and they're paying a small fee for that privilege of being alive. You need to talk to someone, especially RX Property, because the reality is that you need clients to see you somewhere. You can't do this in your backyard. You can't do this in a tent in the Blue Mountains. You're going to have a good practice. So number one, get up your structure right. Number two, make sure that you've got the right location. You've always heard this 1,000 times in every one of these self-help books. Location, location, location. It's true. Your location is the postal code and the destination where everyone wants to see you. But then how do you get the location? Hello, Loan Lounge. Loan Lounge is going to help you get your location. And the important thing about the location is that this is the building that you might be investing in for the next 40 years, or speculating in for 20, or soft renting for a few. But the important thing is that that location is going to allow you to do the work that generates that cash flow that you need in order to pay for your life, your assets, your future goals, and your future plans. And then other things on top of that is you need a lawyer. The lawyer's not there because it's an American TV show and that someone's going to throw you in court for something. A lawyer's there for simple things. You need agreements. You need to have employment contracts. You need to have terms and conditions. You need to have a website. And the website's going to have privacy rules and terms and basic language that protects you as a professional working in Australia.
Also compliance, right?
Guys, the iceberg, 90% is below the water. And we will never cover it in one quick chat. Yeah. But the truth is, I mean, if we started off just getting finance, what does a person need if they want to just buy a simple property? What's the starting point?
Yeah, so the starting point is really, first of all, having that vision, right? Wanting to actually buy a warehouse or an industrial property or a retail space, whatever it is. And then, like I said before, those 5 C's that we go through. But what we do is we sit down with you or the client, and then we just do a fact find, a needs analysis, and just really understand where you're at. And basically we go through like assets, liabilities, income, expenses, and then break down like whether you can actually afford to acquire this property. We look at the asset, whether it's acceptable to the lender. And then we go through that application process, which I'll work with the client. I'll submit that application to the lender. Within usually 5 to 10 business days, we'll get an answer whether the bank will accept it or not. And then we'll send out a valuer, value the property, make sure that it's an acceptable security to the lender. And then once it's approved, we just sign the contracts and then just wait to settlement. But I think the question, when you go back to thinking about starting a business, there's just so many different decisions that you make. And I always use this kind of like this filter, whether like you have the time, the money, or the expertise. So time, money, expertise. Do you have the time? If you don't have the time, then like you got to hire someone and use someone. You can't do it all yourself. Do you have the money? If you have the money, it makes it a lot easier. You do have to have some type of money.
But if you got the money, why do you need the business?
Yeah, that's right. That's right. So you're trying to like start and get this going, right? And the other one is time, money, and expertise. Like, do you have the expertise? And if you don't have the expertise, you need to build a team. And like you spoke about, lawyer, financial planner, broker, and like we just have 3 professions here: real estate. But you need to actually build that relationship with an accountant over time. Like if I was your client, I was a new client, I'll be calling you, like, hey Zander, can you help me do all these things? If I haven't built a relationship with you, I think you're going to be very reluctant to spend that time.
Always beware an accountant that does not share his mobile number with you.
What about doctors?
Well, okay.
I'm being facetious. Sometimes you don't want to get those calls in the middle of the night.
I think
Please amputate the left leg.
But I think this is a real question because if a doctor called me, right, and I know that it's a new business, and a new business, there's no income there. I'm going to have to spend some time on this transaction and really look at like the business plan, the cash flow forecast, a lot of things that are going to be involved. But if I haven't built the relationship with the doctor, I think it's going to take me a bit of time to build the trust first. And it's the same as an accountant.
Something that real life stories from the wild. One of our clients, I'm not going to mention any industries or types, he actually became quite friendly with NAB, which is one of the big 4 lenders here in Australia.
Yeah.
And they made him jump through all of the hoops. They made him do everything. But when you were talking about the 5 C's, the first C is character.
Yeah.
They've already been talking to him for 12 months and him explaining what he's doing and how he's going to do it.
Yeah.
And by the time he was ready to go, the entire document pack, which is unfortunately, that's the way it works. There is no such thing as just ticking a box. Document pack was done. Cash flows were sorted out. Understanding of the earnings and the serviceability was finished. Loan was granted 2 weeks.
Yeah.
And Nathaniel, with the timeline between applications submitted, so let's just say that you've had somebody come in, they've gone through the consultation, fact finding, assets, liabilities, all those different things that you need to do to submit the paperwork from the bank.
Yeah.
Typically, how long does it take to get a loan approved so that you can get started and have that money hit your bank account?
So typical purchase process would be the 6 weeks or 42 days. If it's a like equity release, we're trying to take some money out of some properties.
What is an equity release?
That's a good one. So I think a lot of people don't know this, but if you own a property already and you have a loan on it, so let's just call it $1 million property, and you have a $300,000 debt. So the way that I tell people is just always think about the magic number, which is 80%. Always think about 80%, because if you borrow anything above 80%, like the banks don't usually like it, there's mortgage insurance involved. But if you keep it at 80%, typically the lenders like it. They're okay with lending you the money. So if you have an asset worth $1 million, you just times it by 80%, which is 800,000. You minus the existing debt, 300,000. Will leave you with $500,000. So to access that $500,000, provided that the purpose is correct, then you can access that money, provided you can pay for it. And that money is very easy to access, provided you have the capacity and the income to access
Serviceability.
that money. Yeah, or serviceability.
I think we need to do another podcast because we need to go through the list of all of these terms and terminologies and acronyms and things we do, because it's a lot of stuff that we take for granted that someone else wouldn't know.
Why don't we pull together a glossary?
Yeah, not a bad idea.
And we can post it up. We're happy to share that.
Yeah,
really good.
Because most of these things like LMI,
yeah,
LVR, equity release, these kind of things. You say this to when I was 13 years old playing video games, and someone had to mention these things to me. I would never imagine in the future that this would be an important concept in my life.
Yeah.
But now it's one of the most. I mean, come on. That's one of the next little tricks we haven't even spoken about, using the equity in one property to then finance the next one.
Yeah.
Especially if you're a doctor, especially if you're in the medical field.
And so I guess the instance of buying a property, that's the process that you talked about. What about if you're trying to finance something like a fit out and you're saying, okay, I've gone and I've found a property and it's a cold shell. So over and above the purchase price or the rent that you're going to be paying, you're going to need to now finance the fit out. Where and how do you do that?
Yes, so the fit out would require probably like a builder or a building contract. So we need to find out like how much it's going to cost first of all, right? But the kind of dynamics of lending still apply, like how much capital you're going to put in, or do you need to finance the whole thing? The collateral is going to be like what's in that fit out. Like, is there equipment? Is there specific things with serial numbers? And then the third thing is like your capacity to repay that fit out, right? Like, what's the income that's going to come in that you're going to generate from this fit out, whether it's a new fit out or if you have an existing business. I'd say if you have an existing business or some type of income that's coming in already, it's a lot easier to buy your second or your third. But the initial one, there needs to be some type of, like, you need to think it through, like kind of customers that you're going to bring in, the cash flow that's going to come in. Because if it's...
Sick people.
Yeah, sick people. How many sick people, you know?
Or people that are actually wanting to provide a stable future for themselves by looking after their health in a preventative context.
Yeah. Yeah, so the dynamics of lending don't change, whether it's a fit out or a property purchase, or even if you're purchasing a business. I think even if it's a little personal loan, right, all these dynamics still kind of play.
Is there such a thing as too small? Like if you were just trying to do a very small little consultancy?
How do you define small?
Like... If you wanted to be a dentist that only sees a couple of people a week and you have this little side office, is there anywhere where a bank actually just says no to you? We can't deal with this because it's not at the range that we're looking for.
Yeah, I haven't come across that challenge before. I guess if it's like a few tens of thousands of dollars, right? Why would you go out and get a term loan over 30 years when you can just go get a credit card debt?
That's what I'm trying to get to. So effectively, going back to the savings and light capital means that there's a certain threshold where you need to make the decision as a medical practitioner.
Yeah.
I have to buy or rent or finance something that I can use for the future.
Yeah.
I can't just deal with small things. It's not like a shared space. Or what's that company that went bang? WeWork.
Oh, WeWork.
You can't do a WeWork if you're a doctor.
Yeah. But I think most of the time, like often clients that come to you, they're just like, I need to make a decision, or I've been looking at property, or I've been looking at these options, right? But before you look at these options, you actually need to know where you're at, right? Where you are, like financially, and whether you can make that decision. So to be able to make that decision, you need clarity around like where you are. And so that's why you need a team. You need an accountant, like, to know your numbers. You need to sit down with a broker to see what you can afford.
And a property advisor.
Yeah, and a property advisor.
Yeah.
And that's really how you make a decision.
And I guess one of the simplest ways to look at it is that when you go and look at large businesses, do they have a department head for each sector? So you've got HR, you've got your legal department, you've got your chief financial officer or your finance department. You've got all of those different things, and you've got your executive team and your CEO. Sometimes it might even be logical for a doctor that's got a great service and has productified their business to actually put in a general manager to actually run the show. Yeah. You know, like that is something which then, from my understanding, when you go and it takes, it's time to take it to the market, you could step out of the business in some instances and sell that for a multiple.
There's a reason a lot of doctors have MBAs. These are the kind of things that they think about. We've got a really great example from Chatswood that moved up here into the Bondi Junction area. And their general manager is an ex-nurse that became an MBA and is now not touching anything medical, only commercial. That's how they grow. That's how they get bigger.
So you're saying they have to study for 10 years to become a doctor and then do an MBA? Come on.
Well, look,
no one teaches you business.
It's true.
You can either go to university and do it, or you can learn through your networks, or you can outsource the problem to people that actually know, as long as you can trust them.
It's exactly what you said. You've got a department for everything. If you're a small business and you can't afford the payroll and the headcount, what you do is you outsource. That's why people have bookkeepers, payroll, HR, accounting, management of the properties. That's why we have rent rolls and we use the big rental management companies to do these things. Because you're not the one that's going to be the one necessarily setting up all the rental tenancy agreements and taking their deposits, chasing them down for last month's water costs and the electricity and whatever it might be. This is not the role of what you're doing. Your focal point is your industry. And everything that's on the side is something that you're outsourcing.